44 is with Shannon Roberts of Outline Financial, and I'm very happy that you joined me today.
Yes,
Thank
thank you for
you.
having me.
I go back with Outline Financial back to my Chestnut Park days when you guys used to come in. And I don't want to steal your thunder, but I was always very, very impressed with what Joanna and Jason have built. You take such a data focused, analytical approach. It's not just this kind of like, let me tell you what the rates are right now. Let me tell you who, that idea of like the best rate is the best deal. You're
Right.
very like, what's the long term approach? A bigger picture. And I'm really excited because we got introduced through a client,
Yes.
which I feel like I get the best connections through. So
Yes.
welcome.
Thank you. Thank you so much for having me.
Yeah, and thank you for agreeing to be on the podcast. So we said we'd start where I find it's really interesting that you came from a bank background. So maybe you can tell us
Yes.
a little bit about yourself and what got you to Outline, and then we can go into Outline a little bit.
Awesome. So I've been in the industry for about, can't believe it's already been 10 years, but 10 years. So started with the bank, started underwriting mortgages, which just means intaking clients' applications, working against the bank's lender policy, and then approving or declining mortgage applications. So it really got me to see the nitty gritty and understand the basic root of everything that needs to go into an application. But then I was really limited in terms of I could make sense of the situation. I could see a solution, but I just couldn't get the solution at that bank because I could only have that bank's products.
So, I mean, again, Shannon was the one potentially that had your file, that you got all of the information. And, I would imagine it was a plug and play scenario, right? So we don't need to say what bank you were with, but it's typical in any bank. You plug in the numbers, they look for the ratio, and then it's like, you pass, right? Red or green light. Would exceptions come to you, or did that get put into like a different department? You were very much just like, these are the parameters with underwriters.
We had to put the deal up for exception. So I think that enhanced my skill as well to try to think about how we could get this deal to work, but you're really trying to make it fit in a square, like round, whatever that saying is, square peg, round hole.
It's true, like square peg, round hole, because again, it's not about what a nice person you are. It's not, whether you do community work, but it's really like, do your numbers make sense for the bank? Yeah. And do they think that you're a worthwhile risk to them? Yeah. Right? And every bank has different exceptions and different risks tolerances. So interesting. So, and then you got to Outline, which is a private mortgage brokerage. Yeah. And so how did that happen?
So I joined, still with the bank, but I was a sales rep for mortgage brokers. So mortgage brokers would call me with the situation and I would try to help them package their deal. Okay. And then had a life-changing conversation with Joanna, and she said, why don't you come over to this side? Because I was definitely helping. I felt like I could do it. Not necessarily better, but I could do it
on the other side.
Yeah. And so then she said, come work with Outline. I worked as an underwriter under Joanna. So got a crash course in working on the broker side. Yeah. And now we have access to over 30 different lenders and different solutions for clients, which is awesome.
So interesting when you talk about underwriting for Outline, because that's a unique proposition for Outline. They really don't leave anything to chance. So maybe you just want to touch on that as well, because I think that's a real differentiator for you guys in the market.
Definitely. So our whole team they've come from some sort of lending background and have that experience. And so we intake clients' applications. We are reviewing everything and seeing what lender policy it's going to fit through. We're reviewing all the documents up front to mitigate any sort of surprises. And so we have with our background, especially when we're pre-approving clients, we know exactly what exceptions are going to be needed at the time that a property is found, or what fits, what might fit. And when we're sending an application to the lender, we have a very good confidence level it's going to get approved.
Yeah, which I really love about your process as well. It's not just like, oh, we do a lot of business with Scotiabank. We'll send it to Scotiabank. We know people there. Like, we can probably get you this rate. And it's a not, there's great, I'm not disparaging anybody, but it's a different approach, and it's much more numbers driven ahead of time, right? So it's like you're pre-approving them before you even go to the bank.
Yes, and we're also looking at the client's situation, what their plan is, if like they're looking to buy a home, but then they're looking to renovate it right away, or if they're looking to sell it in a couple of years. Like we know the different policies in the banks that we're going to put you with or not put you with.
So, what are you seeing right now? I mean, we're just on the cusp. So this is going to air this weekend. So the first weekend of March. And I think it's like the calm before the storm, personally.
Totally.
I am seeing a lot of inquiries, referrals. We're thinking about X, Y, and Z. Clients who've been talking to me for the last year finally saying, okay, it's time to come and do a walkthrough. What are you seeing on the because it should be similar, but almost one step ahead.
Yeah. So since like probably the second week of January, we've been getting tons of pre-approval calls, whether it be new clients who have been on the sidelines for a couple of years saying like, this is the year. I don't know if it's because of the bank, like the rate forecast that they're supposed to come down this year. That's just, just getting people like ready to get prepared into the market. Yeah. The inventory is still relatively low, which I think is a limiting factor for clients, but we're seeing a lot of the transactions that we're seeing happening are a lot of first-time home buyers in the $900 to $1.2 million range that we're still seeing clients come out in multiples, but they're getting, multiple offers, like competing in multiple offers. Yeah. But we're seeing clients get pre-approved, make sure that they have a rate hold in place, and making sure they have all their ducks in a row to put their best offer forward.
Yeah, I wouldn't say demand went anywhere over the last couple of years. That's for sure. Just a matter of, I did a podcast the other day. I don't remember who said it. It was like, there's only so long, that a child can stare at a toy and not buy it, right? And so exactly. This on a different level, but all the haters out there, like on social who are always like, real estate agents are always here, or mortgage brokers are always here to like sell something. The reality is that, we know that demand has been there for a while. And now with rates, it's not if, it's when they're going to come down. It's very interesting to hear that, what would you say the percentage, like, so you've been there for 3 years. So last year, this time, what would you say the difference in volume would be?
That's hard to say because, this time last year, the rates
That's what I'm saying. Dipped. So it's interesting for me to understand, like on your side, like I would say I definitely had, I saw steady early on and obviously it dropped, but I didn't see this volume last year.
No, I agree.
Of activity in the background, like of just continuous, definitely. Like I'm thinking it feels like it during COVID, I was getting a referral a week. Let me introduce you to this person, someone else calling me. It started to feel like that about a month ago.
And clients are more serious and like we're going through different budgets and they seem much more further along in their process than this time last year when it was just like, okay, I'm thinking about it and not necessarily ready to pull the trigger. Right. But there's a different sentiment this year for sure.
Yeah, I think people have to run their numbers a lot more than they ever had to, knowing that the rates are going to come down, but the days of 1% and 2% are over. Yes. So, what are those numbers going to look like for them over the next 5-10 years if they do jump into the market or even buy up?
Yeah. No,
I think that's also a big conversation.
And that's something that we do with all our clients, especially at the pre-approval stage, is I can tell you, sure, you've been pre-approved for a rate of 5.5, but you're more concerned about what that monthly payment's going to look like once you actually close the mortgage.
Oh my God, yes. Yeah, it's not pretty anymore.
No.
That's for sure. Oh, there's a thunderstorm going on right now. I can't believe there's a thunderstorm in February. So speaking about rates, I was just saying to you off camera, I did a social post about the Bank of Canada. Well, it was Desjardins, which I don't know, everyone hates Desjardins. They were like, since when does Desjardins know anything about what they're talking about? But they were predicting that the Bank of Canada was going to cut the rates in half by the end of next year. So that's a big statement. Yeah. My comment on the social was just that the rates were going to come down and demand is still there. And once rates start coming down, everyone's going to come back to play. I mean, that's just it. I mean, we're seeing multiples happen, not everywhere. It's very product specific. It's very price specific. Yeah, I mean, I would say like the East End, I would say in the last few years was always very immune to anything that went on in the market. Everybody always wanted to live in the East End, and even the East End felt it over the last year or so. But that's starting to come back, but not every single listing.
Right.
So what is Outline seeing? What are you guys forget Desjardins? What's Outline Outline predicting?
Well, we can really only go by what the big 6 banks are putting out their forecasts. They update their forecasts pretty much every month. TD has yet to do it for February, but the rest of the banks have all updated. For
February, really?
Yeah.
Is that a little late?
Yeah, but I guess we have 2 more dates. Yeah. So all the big banks are predicting that the rates are going to start to drop in Q3 of this year. So that's it could be as early as April. I don't foresee anything happening next meeting. Crazier things have happened.
Oh, in March? You mean March 6th?
Yeah, March 6th. I think that it's way too soon.
But I was predicting April all along. I was like, I think it's going to be earlier than everyone thinks.
And it definitely still can, because we have a whole month of reports to still come out. Like we have the inflation, unemployment, the US Fed rate, like all of that impacts what's going to happen with the Bank of Canada. Mm-hmm. And then, so the big banks are still predicting that it's going to come down between 0.75 to 1.5 this year.
Okay.
And then another
1.75 is huge.
0.75 to 1.5.
Sorry. I was like, that's big.
And I think 1.5 is really aggressive. Like the markets are really are capturing 0.75. Yeah. I think the Bank of Canada is a little bit too nervous to come down too quickly, too fast.
And my prediction, again, was not that they're going to cut them in half this year. I just think, so first of all, I found it very interesting that they announced that miraculously inflation all of a sudden dropped under 3%. I found that wholly suspicious, personally, because there's a lot of people going, well, then why is gas so expensive still? And why are my groceries still expensive and all of that stuff? So whatever. I'm not here conspiracy theory, but, they have always kind of piggybacked on we can't do it until inflation. Inflation's always been that marker, that goalpost. And then all of a sudden it falls below 3%. It won't happen in March. The next one after that is April. Yeah. And then we skip to June. Yeah. So then the question is, do they wait till June, or do they do a slight? And then the question is, what would be the point of a slight one? What would be the point of 0.25 basis points?
I think that's when they're coming down, it's only going to be in 0.25 intervals.
At the beginning.
Yeah.
Yeah. Yeah. So I agree, because they wouldn't, they don't want to set anything off. They don't want to say, oh, we'll give you 0.5, because then people will just, it'll push it up. But then on the other hand, you're like, do you just wait and then do something a little bit more substantial?
And so Bank of Canada rates impact variable rates, and then the bond yields impact the fixed rates.
So let's talk about the fixed rates and what you've been seeing. Because I think that, I think the average person, not for intelligence or anything, is just they hear rates, right? Yeah. So, and the only thing, for whatever reason, that the media reports on is the variable rate connected to the Bank of Canada. Yeah. But I don't know what the percentage is, but how many people go fixed versus variable? I'm sure it's not a 50-50.
So on average, historical over 10 years, 25% of mortgages are variables with the banks.
That's it?
Yeah.
And yet over the last 25 years, the best rates have been variables. until the last couple of years.
Right.
Not so good.
But variable rates are not necessarily for everyone. You have to have a comfort level that, like,
it's a risk. Yeah.
There's something to be said being able to sleep at night knowing that your payment's not going to change, and that's just how set it and forget it. Yeah. But over the past year, variable rates have gone super down in terms of what people are taking, and fixed rates have been on the increase. But so just for some data points, because we've analyzed it all based on the big 5 banks that report. So in July, all of mortgage originations, 5% of mortgage originations were variable. But in December, it had increased back up to 20%. We're taking variable as of December mortgage originations.
Why? Why do you think that is? Because that's so interesting to me. That's a huge jump.
Huge jump.
And nothing's really happened with a variable. I mean, they'll start to cut it, but it won't be anything substantial
enough. Other than the Bank of Canada saying that they're not increasing rates anymore. That's when the announcement came out in December that they were stopped with the increases. They
increase them either. So.
Yeah, no, exactly. And the discount started to improve. So, because the variable rates is always a discount off of prime, so those two things made it that a more attractive option, because as the rates are going to decrease, your mortgage payment. It depends, but your mortgage payment could decrease or stay the same, but more is going towards principal.
Right, depending on what product you bought. But so just throwing it out there as of whatever date it is, February 27th, what is your average, or what's the best, 5-year fixed rate that you've given someone recently? And then what's your best 5-year variable that you've given someone? Like, what's that delta now?
So it's still about a percentage point. We're honestly not doing a lot of 5-year fix. That's not necessarily where
This is where you see a good brokerage when they're not selling the 5-year fixed. Yeah.
Yeah. I mean,
let's talk about what someone should get for sure. We'll talk about if you're getting into something, what you should buy.
And the advice is going to be different for everyone. And I'm talking more for conventional mortgages. So you have 20% down payment, not insured. Right. Insured is different. Yeah. And we can talk about that as well. But with conventional 20% down payment, you can go up to a 30-year amortization. We're leaning more towards the short-term fixed rates, so you can get a 1, 2, 3, 4, 5-year term.
So I think that's it. That's what I kind of wanted to focus on was, I think, and in fact, when I did the post the other day, I had a client who kind of made this hilarious comment, like, calling for rate cuts, because her mortgage was coming up for renewal. And I said to her, if you're going, like, whatever you do, consider talking to your mortgage broker about a 1 or 2 year maximum right now, because why lock yourself into anything else if you're on the downward slope? Yeah,
no, exactly. Right. And there's a lot of forecasts are what they are forecasts. So there's a lot of unknowns over the next couple of years. The overall consensus is it's going to come down. Yeah. So if you lock into a 5-year term, the bank really, really has you. Like, the penalty to break that mortgage is going to be astronomical, that if you're in a 2 or a 3-year term, it gives you a lot more flexibility.
Hundreds of thousands of dollars for sure. So I've always wanted to ask a bank, I mean, I know the answer, but how much did the banks push the 5-year fixed? Like, was that not their bread and butter?
Yes. And I still get calls from bank reps being like, what are you seeing on a 5-year right now on exception? And I'm like, I don't know.
Not doing them.
I don't know, because I haven't done a 5-year fixed I haven't done a conventional 5-year fix in a very long time.
Right. I mean, unless, a client wanted it for whatever reason, for sure. And I get that. And like you said, I had a client in the middle of COVID, when like variables were like $1, and they were like, oh, we just got approved for X. And I just thought to myself, wow, that sounds high to me. And I said, but you went fixed? Like I said, you went variable. They said, no, fixed, 5-year. We don't want to even, like, because again, their risk factor was, I want to be able to sleep at night for the next 5 years and know nothing is going to happen. Yeah. But even myself, I went to renew my cottage, and my bank manager was like, okay, well, here's the 5. And I said, that's not, but like I actually emailed her and said, I would like to know what your 3-year fixed and your 3-year variable was at the time. And she's like, no, you don't want those. I'm like, do I not want those, or do you not want me to buy that, right? Yeah. Oh, fries are ready. Sorry. So, yeah, I think that's interesting. So you saw it also. They were really, they do push that. Yeah. That's their bread and butter.
And it has historically been like a default rate, but definitely not in this environment when we haven't seen rates this high in like several years.
Several years. Oh
like decades.
Decades. So, okay, so someone is coming to you now. They're looking to renew. They're looking to get into the market. You're really saying at maximum, how many years are you recommending people to get in? If it was up to you.
Yeah,
like if they
obviously every situation is going to be different, right. But I would say a 3-year fixed is the high, one of the high, like the upper limit of the fixed rates that we're seeing. Like 2 and 3 year are most popular right now. Mm-hmm. The 3-year is like in the low 5s right now, which makes it attractive, versus a 2-year is in like the high 5s, low 6s, depending on the circumstances, which is closer to the 5-year fixed. Right. So some people are then saying, okay, if it's a 2-year or not a 5-year fixed, a 5-year variable. Yeah. So then they're weighing between a 2-year fixed or a 5-year variable, because a unique feature of the variable is you can lock into a fixed rate at any time. So some banks allow you to take a 5-year variable, and then next year, let's say but your goal is to have a fixed, and next year you're comfortable with where the fixed rates are, you can lock into a 3-year at that time, even though you still only have a 4-year term left. Some banks will let you lock into a 3-year, or you do need to, some banks will make you
pay a penalty, but the penalty,
or not even a penalty, just if you're 1 year into a 5-year term, you have 4 years left, so you have to lock into a 4-year fixed or a 5-year fixed.
Interesting.
You can't go lower.
Okay.
Because you technically have agreed to a 5-year contract in that variable, but some banks will let you go as low as a 3-year fit.
There are so many products. I mean,
many products.
I keep saying to people, like when you're going into a bank, I think the average person just knows a 5-year fixed. Like that's it. You go in, you get your 5-year fixed. I am sure in my lifetime before I was an agent, I had a 5-year fixed on something. And I think, you just go in, you set it and forget it, and you don't worry about it. And a lot of people, by the way, just don't want to. They're like, I don't want to renew in the 100%. Next 2 years. What is it really going to save me? Yeah. I got to tell you, it could save you a lot.
Oh, yeah.
It really can save you a lot. So what are you also thinking, like, so if rates are coming down and you have people who are coming to you for pre-approvals, so how does that work where, for anyone out there thinking about it, I'm going to get pre-approved, and you give me a rate that's good for 120 days. Yeah. That's pretty average. But what if the rate goes down in that 120 days? How does that work?
So you're always going to get the lowest rate. So if the pre-approval rate comes down, then we'll lock that in. And there's different rates on live deals as well, because not every lender offers pre-approval rates or pre-approvals. So it opens when you do have a live.
So that's interesting. They will not give you a pre-approval unless you have a signed agreement of purchase and sale?
Yeah, some lenders. Not necessarily, like all big banks will offer you a pre-approval.
So like a B lender maybe.
Not even a B lender, but like different monoline lenders, credit unions. That they're still A lenders. Yeah. And they have some great products. They have different rate specials throughout the year. That sometimes they might be better than the bank's rates. Okay. But they don't necessarily offer a pre-approval. Okay. But even with the banks, they offer you a pre-approval rate, and you can negotiate a better rate on a live deal, because then they know that they're actually getting the mortgage, they're getting the business. Yeah. They can hedge the rates against where what the market currently is and where the bond yields are. That let's say we pre-approved you at like 5.5, but now like we might be able to get like 5.09 or 5.19 in rate negotiations.
Isn't that stressful for the buyer, though? I mean, not to have something in writing from someone knowing that they have a budget to go out?
Yes,
I
but
mean,
you'll always have the pre-approval rate. So that's going to be your worst case scenario.
okay, gotcha.
And then you can be, hopefully it's just going to get better if the rates come down.
Right. I mean, the reality is, and I've said this before, but, you know, pre-approval is pre-approval based on like the, you know, on an imaginary house. You
Yes.
don't actually get approved until that agreement of purchase and sale is signed and sent to the bank.
Yes.
And then the bank will process. They'll look at you on paper and say,
Yes.
you could be eligible for this.
And if you're getting a pre-approval, you want to make sure that you are submitting documents and having somebody look at your documents.
Oh my God, yes. No, not on your app. Please don't do it
No,
on your app.
not a 30-second pre-approval, because you
Oh my
need to have
God,
an
yeah.
expert looking at it to make sure that there's no red flags or surprises.
You've
Exactly.
right. You've changed jobs recently, changed industries,
Got a loan
bought a
that
car.
wasn't. Yeah, exactly.
All of that stuff, which can't be captured in a 30-second. So, I mean, again, I guess same thing. Like, so if I'm going out and I'm not sure what I want to do and I want to buy something, do I really have to rush out? You know, like, what's the benefit of getting pre-approved now compared to doing it in a month when, like, listen, everybody's going to wait till everybody else is doing it. That's the way this world works. No one wants to do it when no one else is doing it, right? So if my neighbor's doing it, then I feel like I'm missing out and I should be doing it. So we all know once the market heats up, it's going to just go back to normal. But so here I am, I'm a first time buyer and I'm like, why do I need to get pre-approved? Like, I'm going to wait and see how low the rates go, or what's the benefit?
So the benefit is that you have an expert immediately in your corner. Your pre-approval is on our radar. So if the rates go down, we're going to let you know. We're going to immediately get that lower rate.
Yeah.
The rates also are not necessarily going to be, even though they're going to go down, it's not going to be a linear movement. So getting there's no harm in getting a pre-approval. It sets you up to put the best offer forward. And it also just protects you in case anything unexpected does happen, that you have something locked in. If 120 days comes up
and you don't use it,
it's no harm done. You can just reapprove the rates for a new 120 days.
And let's dispel the myth that it hurts your credit rating to get
Exactly.
pre-approved.
Yes.
It is not true.
No, the credit bureau is designed to be pulled. You're not. It's not impacting your score. No, 100% not.
It's when you do something out of character, like out of the norm, and you have all different kinds of credits being pulled for different things. That's a different story. So if you're looking at a commercial property, residential, you're getting a car, you're buying credit cards, that's a whole other issue. I mean, I think the other thing, and I've said this to clients also, is there's nothing worse than, because people are like, I'm not ready. I'm just like, I'm keeping an eye. And I'm like, okay, do you know what happens? Tomorrow, your dream house will come on the market. And then you're going to be like, oh my God, and my ducks are in a row and I can't offer it. And then there's going to be competing offers and you have to go in with a financing clause because you don't have your ducks in a row. Yeah. And guess what? They're not taking your offer because even if it's higher, they wouldn't chance it with a financing clause. So, okay. So before we leave you, I will put you on the spot and just say, where do you think the bond market's going to go? And where do you think the fixed rate? So we have lots of predictions on the Bank of Canada. What do you think? Because it's been really up and down.
It has been. And it's like every single like economic report that comes out, it really puts the bond yields in it's been a little bit of a roller coaster ride.
It's been crazy.
They've something really interesting. So from October to January, the bond yields came down 1% because that's when the Bank of Canada said that they're done raising. So that's that announcement alone reacted. So in January, as of January, it came down 1%. And then from January to February, it's crept up a little bit with the US Fed announcements that came out, about 0.5 percentage point. But the rates are still about a full percentage point lower than what they were in the fall. So from a borrowing power perspective, and this is why also getting a pre-approval is important, because if you're going to the maximum of your budget, your client's purchasing power since October has increased 11% on average.
That's huge. That's another like 100,000 plus
exactly.
on $1 million. I mean, that's the reality of the average. But
Yeah.
I mean, it shocks me that they don't talk about the fixed rates because it's affecting the market and the ability for people to go out to market. And it also could be one of the reasons why people are out and about purchasing January, February more than before, because they can actually just get more. And again, it could be 1 year, it could be 2 year. They're just getting into the market and then they'll roll it over.
Yeah. And even if you don't want your mortgage to increase, like in terms of 11% increase to your purchasing power, if your mortgage stays the same, your payments are about 11% less.
Yeah, or you just put more money, like you could, I mean, I think that's also the big myth is like you can buy less and pay more and more money goes to your principal and just pay it off faster.
Exactly.
I think that's the other, like, I mean, there are a lot of people that don't understand, like, let's say you get approved for $7,000 a month, whatever your payment is, but you only, you buy something and you only want to pay like you only end up paying $5,000. You can put an extra $1,000 in there and cut an enormous amount off your amortization.
Yep, exactly. Set it right away. So in your head, your mortgage payments are always
bring it down
exactly.
if life changes. You have a child, you need more money, like all of those things. But for
exactly.
sure. And that is why you need a great mortgage broker.
Yes.
So speaking of, thank you so much for being with us, Shannon.
Thank
I appreciate
you.
it. We'll put all of your contact information and outlines in the show notes.
Perfect. That's
great.
And
yeah, maybe we'll have you back later this year to talk about what we see in the fall.
Yes.